Hi, Michael Kolb here, your CFP and portfolio manager with Evergreen Wealth Solutions here with your August monthly market update. Investors pulled their assets across the board throughout the month of August. This led to declines for all the major US indices, with the S&P 500 being down 1.59% and the Dow Jones and tech-heavy NASDAQ indexes both being down over 2% for the month. But despite these declines throughout August, all the major indices have remained in positive territory for both the quarter and year to date. From an earnings standpoint, we've also seen the declines that have been expected throughout the quarter. However, we expect the declines to be about 9.1%, and with 99% of the companies reporting, we actually have declines of only 5.8%. So that's good. However, it is the largest quarterly decline since Q3 of 2020. From a technical factor, all three major indices remain above their 200-day moving average, providing some support. But from an international standpoint, we saw even greater losses, with the MSCI EAFE falling 3.8% and the Emerging Markets Index falling 6.1%, and both dipping below their 200-day moving average at one point in time in the month. With regards to fixed income, we actually saw mixed results here. The 10-year rate rising from 3.9 to 4.1 caused the Bloomberg Barclays Aggregate Bond Index to drop by about 0.64%, as well as most investment grade and corporate grade bonds. But the high yield index actually had a positive month, rising by 0.28%. So what's happening with the economy here? Well, we can sum that up in one quick phrase, and that is slowing growth or slower growth, but still growth. So it's set to slow down a little bit the second half of the year, but that's exactly what the Fed is intending to do. So consumers and business confidence has pulled back, and there has been rising concerns about the health of our economy, but yet they're still spending, both businesses and consumer, at a very healthy rate. And while we're monitoring it, it is something that actually is expected. Job growth has also increased modestly, but this was due in part to a large negative revision in July's number. And the unemployment rate did actually rise to 3.8%, the highest we've had since February 2022. So looking ahead, slower job growth is expected, but we also have to keep a very close eye on this. So the summary here is that we're having slower growth, but still growth. And in fact, this may be beneficial to the markets and the economy over the long run, because this slower growth is going to provide support for what the Fed is doing in trying to combat inflation. So what are the risks that we have going forward? I'm going to say the same things we've had before. We had a lot of the big headline grabbing events that were in the first half of the year. Most of those have faded and are no longer a problem. Domestically, the biggest risk is still inflation, and we're monitoring that very closely. We may have more rate hikes still this year, but we also have to make sure we're watching weakening equity fundamentals as a possible area of concern. Internationally, still going to mention Russia and Ukraine war, and also the Chinese economy that is showing signs of slowing and may even start to enter recessionary territory. But what's our big long-term outlook here? Well, we kind of think that this slower growth, still being growth as we mentioned, may be a net positive in the long run if this does keep down the inflationary pressures that the Fed is trying to do. So we still are recommending a well-diversified portfolio that matches your goals and timelines. And if you have any questions about that, please reach out to your advisor to make sure that it fits your plan. So the takeaway here is slower growth, but still growth. And this may actually help the Fed combat their inflation.